What if every financial crisis you've ever seen wasn't random at all? What if behind every market crash there was a plan? Not a conspiracy, just strategy. One that quietly moves trillions from your pocket to someone else's. And what if the ones holding the levers aren't who you think? Most people point fingers at Wall Street, the Fed, or some billionaire. But the real shift often starts with a country you probably don't think about: Japan. Yes, Japan. The same country known for sushi, anime, and quiet efficiency, but also a global lender holding more US debt than anyone else. While the media blames American tariffs or political headlines, a quiet move from Japan's central bank can shake markets worldwide, and no one notices until it's too late. You see the crash, but not the signal. You feel the pain, but not the pressure that built it. But here's the thing. If you start looking in the right places, you'll see the signs before the storm. The passive path is about learning to read those signs, and more importantly, how to act when others freeze. This isn't about fear, it's about clarity and timing. Because every time the system breaks, it doesn't vanish, it simply changes hands. From those who don't understand the game, to those who do. Let's talk about how Japan, not the US, has quietly triggered some of the biggest financial meltdowns in modern history, and why it might be happening again right now. Everyone thinks the US is the center of every financial meltdown, but history tells a different story. Look closely, and you'll find that Japan often makes the first move, not with headlines, with interest rates, currency flows, and quiet financial pressure that builds until something breaks. Go back to 1997. The Asian financial crisis wiped out economies like Thailand, Indonesia, and South Korea. Most people blamed George Soros or unstable governments, but here's what actually happened. Over half of Thailand's debt came from Japanese loans. When the yen rose against the baht, Thailand's repayments doubled overnight. Factories shut down. Real estate collapsed. The middle class vanished in a year. Same thing in 2008. Everyone remembers Wall Street greed and subprime mortgages. But few remember that Japan had already begun raising interest rates months earlier. That quiet decision triggered a wave of currency unwinding. Investors who borrowed yen at low rates were suddenly forced to pay back more. They had to sell assets quickly to cover losses. The result? Markets around the world collapsed. And it happened again in 2023. The yen strengthened by over 12% in 4 months. That single move crushed anyone who had borrowed in yen and invested elsewhere. If you took out $1 million loan in yen and didn't earn at least 1.2 million back, you were underwater. The lesson is simple. It's not just about interest rates. It's about timing and currency value. Japan doesn't have to raise rates aggressively. They only need to nudge the yen upward. When that happens, capital flows reverse. Assets are sold, and markets fall. It's like pulling the plug on a bathtub. At first, nothing happens. Then everything goes down at once. And the most dangerous part? Japan never looks like the bad guy. They're not printing headlines. They're just adjusting numbers in a quiet office in Tokyo. But those numbers ripple across the globe. They reach Wall Street, your retirement account, your job security. That's why watching Japan is more important than ever. Because when they start pulling back, it's often the beginning of something big. America is drowning in debt, over $36 trillion and rising. But instead of cutting back, the government keeps spending. So how does it work? They borrow, not from taxpayers, but from the rest of the world. Here's the trick. They issue government bonds. Other countries buy those bonds. America gets the money, and the promise is simple. Pay it back later, with interest. For decades, Japan has been one of the biggest buyers. They lend billions to the US every year, but there's a catch. In recent deals, Japan agreed to hand over massive amounts of capital and let America keep 90% of the profits from those investments. In one agreement, Japan invested over $500 billion. America got the cash, Japan took the risk, and America kept the upside. That's not a partnership. That's financial engineering. Now ask this: why would Japan do that? Because they had to. Their own economy was stagnating, so they needed to park money somewhere safe. And America, with all its problems, still looked better than the alternatives. But the effect is clear. America gets to delay its financial reckoning. It borrows more, spends more. And the moment Japan or another major lender pulls back, the system gets shaky. Debt doesn't disappear, it just shifts. And when it shifts fast, things break. Currencies aren't just numbers on a screen. They decide who wins and who loses. When the US dollar strengthens, money flows into America. Stocks rise. Imports get cheaper. Other countries feel the pressure. But how does the dollar get stronger? It's not just about the US economy, it's about what other countries are doing with their money. For years, Japan kept interest rates near zero. That made it cheap to borrow yen. Investors borrowed in yen, converted it to dollars, and bought American assets. It was called the carry trade. Borrow cheap, invest high, collect the difference. As long as the yen stayed weak, the game worked. But when Japan raises rates or the yen gains value, the trade collapses. Suddenly, those loans become expensive to repay. Investors sell assets fast to cover their losses. That triggers a wave of panic. Markets drop, currencies shift, wealth evaporates. This isn't theory, it's happened over and over. In the late 90s, Thai companies borrowed in yen. When the yen rose, their debt doubled. Their economies fell apart. Factories closed. People lost homes. The same pattern repeats. Borrow in yen, yen strengthens. Payback gets harder. Assets get dumped, and someone else buys them cheap. Meanwhile, the US looks stable on the surface, but it's only stable because other countries are holding the risk. America exports dollars, imports capital. When things go bad, the money returns home. The dollar strengthens, and other currencies fall. This is how the dollar stays dominant, not by force, but by structure. The whole world borrows dollars to survive, and every time crisis hits, demand for dollars goes up. That's why, in every downturn, the dollar rises while everything else burns. And the US gains leverage, because when your money is the measuring stick, you never run out of buyers. Something unusual started in 2022. Both the US and Japan began pulling money out of the system. At the same time, the US raised interest rates. Japan, after decades of easy money, started doing the same. This had never happened before. Two of the biggest economies in the world turning off the faucet together. It wasn't loud, because for decades, these two had been the world's largest sources of liquidity. They printed, they spent, they lent. Now they were collecting. And when lenders collect, borrowers break. This is why Warren Buffett is sitting on more cash than ever before. Because when both the US and Japan are pulling back, everything gets cheaper. Assets get sold. Prices fall, fear takes over. And then comes the real opportunity. The passive path is about waiting for that moment. Not guessing, just being ready. Because timing isn't about prediction, it's about preparation. If both the US and Japan keep tightening, the pressure will keep rising. And that pressure has to release somewhere. Usually in a crash. And every crash is followed by one thing, a sale. Every financial crisis has a hidden purpose. It moves wealth from the unprepared to the patient, not overnight, but always. When the market crashes, most people panic. They sell their assets at a loss. They cash out retirement funds. They close businesses. And that's when the real buyers step in. They've been watching, holding cash, studying the cycle. And when fear hits the peak, they act. This isn't about market timing. It's about recognizing patterns. In 1997, Asian families lost homes and businesses. In 2008, millions of Americans lost jobs and savings. But at the same time, others quietly bought foreclosed homes, scooped up stocks at half price, and doubled their wealth within years. It didn't take luck. It took strategy. Here's the pattern. Hold cash during peaks. Wait for panic. Buy undervalued assets. Protect your downside. Don't chase hype. Chase stability. Don't guess tops and bottoms. Build a repeatable process. Even one big win every few years can change your life. But only if you're ready when it comes. Too many people wait for signs. By the time the signs are clear, the price has already moved. That's why having a system matters. A system doesn't need you to be perfect. It needs you to be consistent. Every time the world tightens its belt, the same opportunity appears. It's never easy to act in fear, but fear creates value. Now the question is simple. What should you do? You don't need a finance degree. You don't need to time the top or bottom. You need clarity. If you're living in the US, Canada, or Mexico, your first move is to hold dry powder. That means cash. Not all of it, but enough to act when the market gives you a discount. Next, stop chasing trends. Avoid high-risk assets that rely on constant liquidity. Forget hype coins, overpriced stocks, and over-leveraged real estate. Focus on what holds value when the music stops. That could be short-term treasury bills. It could be gold. It could be certain commodities. It could even be cash in a high-yield account. The goal isn't to beat the market right now. The goal is to stay liquid and stay sane, because the next drop could be fast, and the rebound even faster. You don't want to be watching. You want to be acting. Look for signs of forced selling. Look for discounts on assets with real-world utility. Ignore anything that depends on endless growth. This is not the time to stretch thin, it's the time to compress. Review your expenses. Cut out liabilities. Build a cushion. Study investor behavior, not just price charts. Watch what people like Warren Buffett are doing, not saying, doing. He's holding more cash than ever. He's not rushing in. That tells you everything. The passive path is built around this mindset. Patience over panic. Process over prediction. When you hold cash, you buy peace of mind. And when markets fall, you buy assets at a discount. That's how wealth is built. Quietly, consistently, deliberately. Like, subscribe, and comment to keep following the passive path. Because the next opportunity isn't years away. It's already forming. Every crisis hides a chance. Every downturn hides a path forward. You've now seen how global wealth shifts quietly through interest rates, currency moves, and policy decisions most people never notice. But you're not most people. You're watching, you're learning, you're preparing, and that's what separates survivors from builders. Remember this, you don't have to predict the future. You just have to position yourself for when it arrives. Hold cash, stay patient, watch closely. And when the world starts to panic, stay calm. That's how you walk. The passive path. If this video helped you think differently, like it. If you want more breakdowns like this, subscribe to the channel, comment below with what part stood out most to you, and share this video with someone you care about, because understanding the system is the first step to freedom. Wishing you clarity, strength, and good timing. Feel free to watch the other videos on the channel to keep building your financial vision. See you in the next one.